Hello and welcome to the second episode of the Global High Tea series organized by the Center for Public Policy Research, which discusses various international developments and their impact on India's foreign policy outlook. I am Dr. Sri Bordeloy, Senior Research Associate in the International Relations Vertical at CPPR and the moderator of today's webinar. On behalf of CPPR, I warmly welcome you to today's Global High Tea series webinar titled Energy Disruptions in West Asia and Their Economic Implications for India. The ongoing conflict in West Asia has triggered not just a regional crisis but also a global economic and energy shock. Disruptions to critical energy routes, especially through choke points like the Strait of Hormuz, have tightened global oil and gas supplies, driving price volatility, inflationary pressures, and widespread financial uncertainty across markets. So, what makes this crisis particularly significant is the paradox it presents. For energy exporting GCC states, it brings windfall revenues even as it intensifies security risks, while for energy importing economies like India, it compounds vulnerabilities across growth, trade balances, and long term energy security. So, today's discussion cuts across the full spectrum of these economic and energy dimensions, from global supply chain disruptions and the fragility of maritime trade routes to India's compounded macroeconomic exposure, inflationary spillovers, shifting financial markets, and the looming specter of stagflation. It is a conversation about how geopolitics and economics are deeply, irreversibly intertwined and what policymakers, businesses, and citizens need to understand and act upon in response. This webinar is an opportunity for us to engage with some of the most pressing questions of our time. How sustainable is India's energy security model? How are GCC economies balancing short-term gains with long-term risks? What does this crisis mean for global financial stability? And critically, what must the global community do differently to build resilience against future shocks of this nature? Before we begin our conversation, I would like to introduce our esteemed panelists for the day. We are honored to have a distinguished panel of Dr. Pooja Bhatt and Dr. Gayatri Gopal with us here today. Dr. Pooja Bhatt is an associate professor at the Jindal School of International Affairs, Jindal Global University, Sonipat, and a research fellow in maritime studies at the Center for Public Policy Research. She is an author of The Nine Dash Line Deciphering the South China Sea Conundrum, published by Routledge in 2024, and was a contributor to the Indian Navy's commemorative history, A Decade of Transformation, the Indian Navy 2011 to 2021, released by the President of India on Navy Day 2022. Dr. Bhatt works extensively on maritime security, policy, and governance, with a particular focus on the Indo-Pacific and the South China Sea. She holds a doctoral degree from the School of International Studies at Jawaharlal Nehru University, an MA in International Relations, and MPhil in Diplomacy and Disarmament, also from JNU, and a diploma from UNCLOS from the Yoso Academy, Korea Maritime Institute. A very warm welcome to you, Dr. Bhatt.
Thank you so much, Ritri, for having me on this discussion. I'm looking forward to it.
Likewise. Dr. Gayatri Gopal is an assistant professor at the Government Arts and Science College, Tavanur, Kerala. She was awarded her PhD by the Center for South Asian Studies, School of International Studies, Jawaharlal Nehru University, and also holds an MPhil from the same center. Her doctoral research examined India's neighborhood policy and the evolving geopolitics of South Asia, with a focus on regional power dynamics and changes in India's regional policy. Her MPhil research explored India-China relations in South Asia analyzing the implications for Sri Lanka's foreign policy within the broader regional strategic environment. Her academic interests include India's neighborhood policy, South Asian geopolitics, India-China relations, regional security, and foreign policy analysis. She is also a research fellow at the Center for Public Policy Research. A very warm welcome to you, Dr. Gayatri.
Thank you, Dhruti. I'm very happy to join the session today.
Looking forward. So let's begin the discussion. We often speak of energy markets as integrated global systems, but this crisis has laid bare how fragile those integrations can be when conflict strikes at the physical arteries of supply. So disruptions in key maritime choke points such as the Strait of Hormuz through a significant share of global oil and LNG flows have heightened supply uncertainty, pushing up prices and increasing insurance premium for tankers. So these developments underline how localized conflict can trigger systemic instability in tightly integrated energy markets. So in this context, Dr. Pooja, how would you assess the scale of disruption to global oil and LNG supply chains, and through what mechanisms are these translating into price volatility, rising insurance costs, and broader market shocks?
Thank you. Uh, Thank you for the question. That's a very good question, Triti. And I think that sets the tone to and follows up to what you started in your talk recent just now. That how and we're just 2 weeks into the closure of Strait of Hormuz, and now already we are seeing the kind of pressures that is on the macroeconomic policies of most of the countries, oil supply and energy. So in that regard, I think the disruption of the Hormuz, Strait of Hormuz, should not be only seen as a physical disruption or an disruption of the supply chain, but it has to be seen in the larger context of cascading impact of these incidents that we are seeing. Because Strait of Hormuz carries 1/4 of global seaborne oil, and therefore it also contributes to a large share of LNG exports from Qatar and UAE. And given that the kind of blockage is reducing the oil flow to the rest of the world and LNG, on which most of the world is dependent upon, I think the global physical disruption is large, but the scale of which the multiplied impact of these are something that we are not just seeing for now, also for the months to come. Uh, Apart from oil and gas shortage, what we also have to consider that the kind of price volatility and the cascading impact of that price volatility that we'll be going to have on products in the coming months is going to have a large scale macroscopic implication on the geopolitics. We have the market expectations are now very uncertain. They don't know how much supplies are about to come, when they are going to come. That is also risking the premiums, the insurance premiums that the shipping lines are paying, and the increase in premiums also comes back to the cost of the products that pass through it. So again, the cascading effect and the price volatility that we'll be seeing in the coming times. Um, Insurance cost is another issue which we'll be also facing, that as the shipping cost will go up, and the price, because this is a very volatile region, insurance prices would be going, because there is a added issue of war here. So war is premium insurance that actually heightens the entire cost to multiple times, is another issue, apart from the threat to life and the shipping lines which is already there. So overall, I think if we see the impact, as you also rightly mentioned in your speech, that it's not just about closure of a strait, or disruption of oil and gas, but it's the larger macroeconomic shocks and market shocks that we are going to see in the coming days, is something which is more worrying for us as scholars.
Thank you, Dr. Pooja, for pointing that Strait of Hormuz has larger cascading effects on India's economy and also the global economy. Now, turning to GCC economies, which find themselves in a rather complex position in this moment, rising oil prices have strengthened fiscal positions across GCC economies, offering short term revenue gains, at the same time, escalating geopolitical tensions that are increasing risks to infrastructure, investor confidence, and long term diversification efforts, creating this complex economic balancing act. Now, in this context, Dr. Gayatri, how are GCC's economy navigating the dual impact of windfall revenues and rising geopolitical risks, particularly in terms of sustaining investor confidence, advancing diversification agendas, and maintaining long term regional stability?
Thank you, Dr. Dudi, for the question. And, as people sitting in Kerala, we are often the first to know when something goes wrong in GCC. It's because of our families being settled there and our livelihood so much connected to this region. So it's worth examining how GCC is going to manage the economic difficulties that they are facing now, because ultimately it's going to affect us too. So now traditionally we assume that when oil price rises, Gulf economies benefit. But what is interesting in this moment is that that cycle is breaking down. Yes, prices are high, but that does not automatically translate into gains. Because the real issue is no longer price. It is whether oil can move and at what cost. As Dr. Pooja has rightly pointed out, so once the trade routes are disrupted, the insurance premium spikes, the shipments slow down, logistics becomes uncertain, and oil wealth, which once the Gulf economy looked at as something guaranteed, suddenly becomes conditional on stability. So this is something we've not addressed before. And this another profound shift that I want to address here. Take, for instance, Dubai. For years, it has consciously tried to move beyond petroleum dependence, positioning itself as a global financial hub, a logistic and aviation center, safe haven, global capital, and so on. So, and especially for the high net worth individuals. So that model depends fundamentally on trust and predictability. And in this moment, that trust erodes. It has already eroded, as we've seen the ultra rich has already fled the city of Dubai. So that is very concerning. And we've already seen signs of capital becoming very cautious, high net worth individuals quietly relocating their assets, and a broader hesitation in long term investment decisions. So, this is where we realize that, financial hubs are not built just on resources, but it is as much built on confidence too. So once that confidence is shaken, it is harder to restore than physical infrastructure. So it's not just about Dubai, even Saudi Arabia, it has been doing a diversification push, emulating what Dubai has been doing. It has been trying to reduce reliance on hydrocarbons, investing in tourism, and so on, so on. But now what has happened is that, the stability, they were trying to project stability, and that very stability is what precisely that is under strain now. So, basically, Gulf has moved from being resource secure to network dependent. And in a moment of crisis, networks, whether financial, logistical, or reputational, are far more fragile than resources. So I think that is the real structural shift that we are witnessing. Now, to answer your question, how they are managing a dual reality, that is short-term revenue gains from oil prices alongside long-term structural risks from geopolitical instability. So, there is this managing of revenues. That is, they are now shifting from spending to buffering. That is, in the short term, high oil prices have certainly improved their physical space. But unlike the earlier booms that we have seen in the GCC, they're not expanding expenditure. Rather, they are channeling these revenues into buffers and strategic investments. For example, sovereign wealth funds, collectively they are worth several trillion dollars as we know it. Then there is also a visible shift towards investing in technology, renewable energy, logistics, and manufacturing. So this reflects another broader shift, that is, oil revenues are no longer treated as income; they're treated as, what we can call it as transition capital. So then I think, as far as sustaining investor confidence in an unstable environment is considered, I think the real challenge, as I've already mentioned, it's not fiscal. It's all about the confidence, because GCC economies are heavily dependent. I've already mentioned global capital flows, foreign investment, etc. So I think they are now pursuing a strategy that combines macroeconomic stability, that is, low inflation, strong external balances. Then there is clear policy signaling that is coming, especially from UAE and all. That is, there's more commitment to openness. There are regulatory reforms that are, underway. And then, most importantly, except for the let's keep aside Iran for now. From the other countries, there's strategic restraint that they are, exercising in a conflict dynamics. So I think this is how they are trying to, and most importantly, there's one more point that I want to mention: this diversification, this more diversification that is happening. You know, in GCC, this, sometimes we don't mention it about the non-oil sectors and how important that is. So it is they're growing faster than the overall GDP. I mean, the non-oil sectors are growing faster than the overall GDP, which is around 3 to 4% annually in many cases. In economies like UAE, non-oil sectors now account for a dominant share of their GDP. So, similarly, Saudi Arabia's diversification strategy has pushed their non-oil contribution to over a half of GDP in recent years. So there is, they have long seen the issues, and especially with Saudi, we know that maybe their resources would last another 50 years, and this 50 years is a small time period for a country. All of us know that. So they've already started diversification long ago, and I'm sure that in the context of the conflict, they are aggressively pursuing diversification. So I think, and then there are renewables, AI, and service sectors. Basically, they're also focusing on service sectors. So I think this is how they are putting up with the crisis. Yes.
Dr. Gayatri, thank you for your detailed stance on how the GCC economies are navigating this impact and the geopolitical risks that it is maneuvering through. So, Dr. Pooja, I'd like to bring you back to the question of trade and logistics. Dr. Gayatri also mentioned a little bit about logistics, so which is an area where the cascading effects of the crisis are being acutely felt. So, heightened maritime insecurity has compelled shipping companies to reroute vessels away from high risk zones, leading to longer transit times, higher freight costs, and delays across global trade networks. And this has exposed the structural fragility of just in time supply chains. Against this backdrop, how are shipping, rerouting, and maritime risks reshaping global trade flows and logistics efficiency? And do you see this crisis accelerating a longer term restructuring towards more resilient supply chain models?
Yeah. I think I teach this course on maritime geopolitics, and one of the things that I used to teach my students that if these straits close, what will be the implications of it? And it's just the nightmare which has come true that what we used to learn and teach in the classes is exactly what we are seeing. And as Dr. Gayatri also mentioned, this entire rerouting or an impact on global geopolitics in terms of how the trade routes have been rerouted. So there are two, three things, and I think I'll answer your question in two parts. So first part is how these rerouting are reshaping the trade and logistics, which is a very, very crucial question. And because first of all, these trade routes of these shipping lines have a very fixed path, which is through straits, because it takes the shortest amount of time, right? And shortest amount of time also allows for a lesser investment, lesser cost of the freights and the cascading impact on the products. Now, when that shifts, and now just to avoid these choke points because of the danger, shipping lines are taking longer routes, so they're avoiding Red Sea and Suez Canal. They're approaching the south of Africa, basically Cape of Good Hope, that the shipping lines are now trying to take, which increases the journey length to up to 40% at any good day. And that means 10 to 20% on an average per voyage would take, right? The number of days that you take, that means the amount of fuel that you use, right? And the capacity also decreases. So you need more fuel, more capacity, you need more ships. There is a further burden on the freight markets in terms of all this. Second, as you also mentioned, that the kind of just-in-time model that used to be always there, because it used to work on very tight, predictable schedules, right? We know when the ship is arriving in these many days, and then that's how the inventories used to be stocked out and production used to be, planned out. Now that also has shifted. So it's not just the shipping lines that are impacted, the back channels are also impacted. The entire predictability has gone for a toss, which again impacts your entire trade. All right. Last impact, which is on the trade routes, is how the very dominant trade routes used to be there. The ports used to be there. Now they'll be replaced by the secondary ports. So now newer ports will come into existence, which is a good change for this crisis. But now we'll see all that also. The second part of the question that you've asked, whether it creates resilience in the supply chains, I would see opportunity in this crisis. And I would say yes. And then there is basically largely in three ways we'll see. First of all, there would be more optimization of cost and speed. So the countries will try to make certain kind of inventory budgeting, and whatever back channel, sourcing is required, they'll try to, relocate on all that. So again, a crisis would be used for opportunity by the countries to redesign their supply chains to make it more resilient. There would be also quite rewiring, as I just said, of the global trade routes and the ports also. So there will be new trade routes coming, and as per with that, new ports would be coming. And so, new countries would be involved. There would be multi-port model, flexible models, multi-lane models. So we might see newer kind of models which will come in the region. And that will also lead to newer geopolitics, because if you have to have trade with other, new ports and new countries, you have to have good relations, political relations with those countries. So we'll see more better political relations with the countries now, with, new ports would be, port relations would be developed. And lastly, there will be also institutional level shifts. So now we'll have a lot of private sector involvement in the maritime resilience, because they are the ones who are operating these, shipping lines. They are the ones who are the port operators. They are the ones who are the insurers. And with that, we'll also see a shift in how UN related bodies will now start to work in terms of, how they diversify their logistics infrastructure, how they look into the stockpiles, how they, incentivize the crisis planning tools. So all these would be, changes that we might now start seeing at these levels. So I think overall it should be good. Short-term impacts do not look good, but I think it will also allow us to expand our vision beyond the fixed trade routes and the fixed, choke points that we are presently looking into. So I think overall it should be a good in a longer term.
Thank you, Dr. Pooja. Uh, I want to turn specifically to India now, and a country whose energy import dependence makes it particularly exposed to precisely this kind of external shock. So, India's heavy reliance on Gulf oil imports makes it particularly vulnerable, with rising energy prices feeding into inflation, widening trade deficits, and straining the fiscal balances. This also raises these deeper questions about how this resilience of its long-term India's long-term energy strategy. Against this backdrop, uh, Dr. Gayatri, how sustainable is India's current energy security model, and what are the key economic vulnerabilities and the gaps, especially policy gaps, that this crisis has brought into sharper focus?
Certainly, this is a very critical juncture for India, both in terms of its economy, because we're a nation trying to maintain that 7% GDP growth, and we also have we equally important is our strategic autonomy. Now, talking specifically about the key vulnerabilities. One is there is a physical friction point. That is, as we all know, I think India imports roughly 85% of its crude oil and 50% of its natural gas. Now, there is this multiplier effect that the economists have been talking about. That is, for every US dollar 10 increase in the price of a Brent barrel, India's current account deficit widens by approximately 0.5% of GDP. So it is not just the multiplier effect, then there's also the issue of inflationary pressure. Because, and for example, 10 again, a 10% rise in crude typically adds up to 50 basis points to headline CPI inflation. That is just within 2 quarters. So basically, that would force RBI into a higher for longer interest rate stance. So these are the two physical friction points that I want to mention. Now, going into what are the key economic vulnerabilities. One is the strategic reserve gap. So India's strategic petroleum reserves currently hold up to 39 million barrels, but which is roughly would last us 9.5 days of net imports. Now, let us compare this to China. China has that of 90 days and US is that of 140 days. So, if at all if at all there is a, God forbid, there's a total Hormuz blockade, India has a very narrow window before the industrial paralysis set in. Now, second important thing that I want to address that, whenever first I mentioned strategic autonomy, we talk a lot about how we leverage the whole Russia-Ukraine situation and, that how we managed to get cheaper imports of oil during the entire crisis. But, there's actually a discount trap in there that we don't mention often. That is the heavy reliance on discounted Russian oil. So at the peak of it, which is nearly about 40% of our imports, it is actually a tactical win, but not a strategic one. That is, as the shadow fleet faces tighter sanctions and shipping insurance cost climbs, that discount is evaporating. So this will force India back to the more expensive Middle Eastern markets. So that is always there. So that discount trap exists, which I don't know to what extent that we are addressing these two critical vulnerabilities that is there. And now let us talk about the EV ecosystem, which we're building as an alternative to all these, oil dependency and all of that. So in India, the two-wheeler adaptation is high. But, what about freight and long-haul transport? They still remain diesel locked. So 70% of oil demand is in transport sector. And without freight EVs, that vulnerability persists. So whether we're shifting to EV or not, when we take this picture of transport and logistics sector, I don't think that is making a big difference. So then we were investing a lot on coal gasification on now. So there is another issue there. That is let's take up timing is very crucial in all of these aspects, as we all know. The goal of 15% gas in the energy mix by 2030 is already lagging. And on that is the continuing overdependence on coal and high emission crude. So altogether, what I'm trying to make it at the sound of, at the risk of sounding very pessimistic, today, our physical health, I feel, is hostage to the Strait of Hormuz situation. With an SPR that covers less than 10 days and a trade deficit that balloons with every major geopolitical trigger. So basically, this whole thing becomes a high wire act. And, the policy gap it is not just about finding new sellers, because in the last entire year, we have been diversifying our imports from everywhere possible. But I think, it is not just about finding new sellers, but it is also about the speed of our domestic transition, as we were talking about alternatives. So until we decouple our GDP from the global Brent, ticker, our strategic autonomy will always have a price tag attached to it. That is what I feel. So, in short, our solution is whatever alternatives that we have. It is also about speed, how efficiently we are able to make the transition possible. Yes.
Thank you, Dr. Gayatri. The ripple effects of energy shocks extend well beyond the fuel pumps, don't they? And I'd like to explore that dimension with you, Dr. Pooja. So, energy reserves as a foundational input across sectors, and rising fuel costs are cascading into higher prices for fertilizers, for food, and other essential commodities. This has intensified inflationary pressures, particularly in economies already facing fiscal constraints. Given these interlinkages, how are energy shocks transmitting into global commodity markets? And in what ways are disruptions in energy intensive sectors amplifying inflation across interconnected ecosystems?
I think it's a very problematizing question to start with. See, because for India, we are very not so transparent country when it comes to fuel prices, and it's very open book knowledge basically that we do not know what actually sets the fuel prices in India, whether it's market driven forces or whether it's state control. More and more it looks like it's a combination of two. So we are so why I would say that, and why most of the scholars would say that, is because when the global market of crude oil for 2 years was low in the past 2 years, we did not see any passing of that benefit of the difference to the consumers. So I'm sure the owners of the petrol industries and companies, ONGC and others, would have made some kind of profit out of it. So that's one thing. But now when the oil prices are globally at high, these are the systems which are still struggling to pass on the price to the hike in the price to the customers, because there is some government intervention which is trying to moderate the oil prices so that it does not have a transcending impact to the customers, just as we have the LPG and CNG. And this is where we are now getting stuck into that. Till the time these companies made their profit, they were doing well enough now, but they are making losses. They just can't transfer their losses to the people. What is happening here, and this is a very important lesson for us to understand, that energy is just not a commodity. It is also a systemic price driver, and which links to inflation. It's not just about energy, it's also about our food industry, our industrial sectors, our fertilizers, our other energy intensive sectors. So all are getting impacted with this, the price hike. And now, so there is a direct impact on the cost of energy prices and freight prices that we are seeing everything. But there is also spillover, as Dr. Gayatri also mentioned. So now we are also seeing the spillover in terms of our fertilizer costs are going up and grains are going up. And India is hugely dependent on its fertilizer and biofuel feedstocks for its, and we are agricultural economy. We are dependent on it still. So that is increasing. And in the coming times, our agricultural costs will go even high. So that is the indirect spillover of this. Third is that our inflationary, we are not still, we are still more manufacturing and into agriculture and construction. Every sector of these, are dependent indirectly or indirectly by on oil prices. So now we are going to see more and more, consumer price inflation in the coming times. And all of this combination of your direct impact, indirect impact, and the headline and consumer price impact, the entire impact is going to go on the citizens of the country. We are going to have expensive fuel, expensive food. We'll have trade deficit pressure. We'll have lower resources in the coming months and maybe year. And what is making it more difficult is we have very, very limited policy choice in terms of geopolitics. We have certain relations with these GCC countries. We have certain relations with Russia. We have certain relations with Iran. and that actually limits our policy choices in terms of how do you manage. And that will remain the most difficult question, that having these deficits back at home, how do you manage your policy? And that would be the biggest shock that your energy shock will be giving you in the coming times. And I think we need to start thinking on those lines, that how do you make your systems more stronger, more resilient, more persistent? So I would see it that way.
Thank you, Dr. Pooja, especially for pointing out who the impact is going to fall most upon, which is the citizens like you and I, who are paying for everyday essential commodities and oil and fertilizers, etc. So, yes, thank you for that. So, Dr. Gayatri, I'd like to bring you in on the financial dimension of this crisis, which is increasingly capturing global attention. So, periods of heightened geopolitical uncertainty often trigger volatility in global financial markets, with investors also shifting towards safe haven assets, leading to capital outflows, currency fluctuations, and tighter financial conditions, especially in emerging economies. So, in the light of these trends, how have global financial markets responded to the current crisis? And what are the implications for capital flows, currency stability, and investment prospects in emerging economies such as India?
Well, what is happening in the global economy right now is what the economists call as the flight to quality. For a longer time, we were talking about emerging market economies. And at this point, capital is actually deserting the emerging markets, and they're seeking shelter in more stable, assets like US dollar and gold. So this is actually for emerging economies like India, this is creating what we can call like a triple squeeze. That is, one, there is a stronger dollar. Second, there is more expensive import. And third, there is a draining pool of foreign capital. So these are the three major issues that I want to address. So as far as the dollar dominance is concerned, even since mid 2024, the dollar has remained structurally strong against a basket of countries. So, and what eventually what happens is that then there's also gold, which is unlike paper currency, bullion carries no counterparty risk, so that makes it a very safe hedge that we all know. And also there is a yield curve that is flattening. That is, investors are piling into these long dated US Treasury assets, and so basically the flight to safety means that lowers the cost of borrowing for US while raising it for everyone else. That is the key problem here. So then the second thing is about the, as now coming back to India's issues, we know we are very much capital dependent. And the most visible scar of all these geopolitical, events, volatilities, that, foreign portfolio investments, it has come to sudden stop. That is, foreign capital just doesn't slow down. It is also reversing. For example, in high volatility quarters, India has seen FPI outflows exceeding somewhere from 5 billion to 8 billion in a single month cycle. So I'm not saying that, there's a no confidence vote on India's growth or something like that, but there's certainly a mechanical rebalancing that is taking place by these global fund managers as they are reducing their beta risk exposure. So what does it mean for us? This means tighter financial conditions. That is, as capital is leaving, domestic liquidity is drying up, and it is forcing RBI to take a hawkish stance, that is keeping interest rates higher to prevent runaway situation for runaway depreciation for the Indian rupee. So having said that, I want to point out that this is the short-term picture of volatility. That is, despite all these financial market tremors, the sticky money, that is FDI. So I pointed out about the FPI, but FDI, I feel it has remained robust. Coming to manufacturing giants, they're still prioritizing India, be it Apple, for Tata, Samsung, whatever. So these big manufacturing giants are still prioritizing India for our supply chain resilience. Secondly, we still have a great amount of market resilience. That is, domestic institutional investors and the retail revolution have created a floor for the Indian stock market. In 2026, domestic inflows often offset up to 60% of the foreign selling. So ultimately, what I'm trying to say is that for India, it is the challenge is not just about attracting capital, but also buffering it. So this is no more the era of efficient market. We have already transitioning into, or at least we have to transition into an era of resilient markets. Yes.
Thank you, Dr. Gayatri. Dr. Pooja, before we close, I'd like to turn to a question of global governance and strategic responses. Arguably, the area where the gap between the scale of the challenge and the adequacy of current frameworks is most visible. So, the recurring vulnerability of critical energy routes have renewed focus on the need for coordinated global responses, including maritime security frameworks, diversified supply chains, and stronger multilateral engagement to safeguard energy flows. So, what do you think the strategy policy responses are required at this moment at the global level to secure critical energy routes, and how can maritime governance and multilateral cooperation contribute to long-term energy stability?
To ensure that we do not get trapped into such, issues of strait and the blockages of straits, I think the responses in the maritime domain have to come from the maritime law, maritime policies, and maritime governance from all the three sides. And if I can just elaborate it a bit, when it comes to maritime security, we need to ensure that most of the countries, and most of the countries are already signatory to the United Nations Convention on the Law of the Seas, they have to ensure that they come together to maybe formalize some kind of multilateral naval presence or some kind of arrangement around these very crucial states, so that we do not get stuck in such situations again and again. We have more resilience. So there has to be some kind of regional security cooperation and agreements across all the, and because in Indian Ocean we have as many as of 8 of these navigational routes or the straits that we talk about. I think we need these. Secondly, we also have to come together in at the security level, and it is beyond the maritime security, but more about the energy security, where the partnerships have to be at both private and public sector. You need to think about those kind of partnerships where the infrastructure development comes across, where the burden sharing is both by the government and the private sector. So there is more involvement from both the sectors in terms of securing your shipping traffic and as well as your supply chain. And third would be at the domestic as well as the global level is the how do you stabilize your market, ensure your stability of your market in such situation. So you need to create some kind of global energy buffers, and some kind of mechanisms where you ensure that even if certain blockades happen at some point of time, you still can recover those shocks in the short to medium term. So I think at this level, we are the secure at the added angle of security that I would look is also how do you ensure the continuous monitoring of these straits. So there again, we have maritime governance coming from the UNCLOS level and also at the very naval kind of level, because you'll have to do constant um, surveillance of those regions. The navies have to come together, the countries at the political levels have to come together. When you do that kind of monitoring, you'll have information, you'll have to have clean, transparent information sharing infrastructures available. You have to ensure that countries who are coming together follow UNCLOS in terms of freedom of navigation, in terms of finding transit passage rights. And this require a very global approach to securing these trade routes. Lastly, when it comes to multilateral governance, I would see that the coalition that I was just talking about has to work at normative level as much as they are doing at the coalition level or burden sharing level. So we need to ensure that more and more countries come together where they agree to this idea on the normative side that choking of these energy lifelines is incorrect, non-use. Like how we had a normative structures for the nuclear during the Cold War, that no use of nuclear weapons, no use of chemical weapons. I think that kind of normative infrastructure has to be created within the minds and also in the your multilateral cooperative framework. So that kind of thing has to come. And of course, once that is there, you can follow up with the kind of coalitions you want to build in terms of burden sharing, how you want to follow up with the financial stability cooperation. That will all fall. But the larger idea, which I think everyone have to come together. I think just yesterday, China and Russia also voted against opening of Strait of Hormuz, which is again a very, it just succumbs to the great power politics. So if the UN does not agree, the two parties of the P5, do not agree to a certain thing, rest of the world is basically succumb to that pressure, and they are the ones who are facing the fallout. So that is why I think this normative understanding that these trade routes are crucial not only for certain trading countries like GCC and the energy consuming countries, but they're also largely important for the rest of the world. And that normative understanding has to be built into these multilateral cooperation, and only then it would be flowing to your insurances and your financial models and your security models. It will only flow from there. So I think we have to start thinking on these issues like that.
And finally, Dr. Gayatri, I'd like to invite you to offer a broader forward-looking perspective on where all of this is heading. The pressures on high inflation, the slowing growth of raised concerns about stagflation, while also prompting countries to rethink energy strategies, diversify partnerships, and also strengthen economic resilience frameworks in an increasingly uncertain global environment. So, given all these evolving dynamics, how do you assess the broader regional and global implications of this crisis, particularly the risk of stagflation and the ways in which it is reshaping energy policy, strategic alignments, and long term economic resilience?
Uh, first of all, starting with the stagflationary trap. This is a deeply, uncomfortable position for policymakers because, inflation demands tightening, that is higher interest rates. But slowing growth demands easing, lower interest rates. And you cannot do, as we all know, we cannot do both at the same time without consequences. So, economies, particularly the emerging markets, are caught in a squeeze, no doubt. They are raising the rates, but to support their growth and domestic demand or whatever. And at the same time, because of currency instability and inflation, they have to cut rates also. So basically, and one more thing that I want to point is that inflation today is not demand driven; it is supply driven because it is coming from the disrupted energy flows and constrained shipping routes and all of that. Uh, so basically, you cannot interest rate your way into more oil or more safer ceiling. So stagflation in this context is not just a macroeconomic problem, it is a geopolitical condition. Now, first we have to address that geopolitical condition to come to this economic problem. And then, from a future oriented in the long run, what we can do about things like this. So first, as far as the energy policy is concerned, for the past decade, we were all focusing on transition. We all know we were transitioning into renewables, decarbonization. We were focusing on sustainability. But crisis, the thing about crisis is that they often impose hierarchies. And today, energy security has taken over the energy transition. So it's not about, safer or greener energy, it's more about stability. So basically, what has happened in most countries, India or other emerging market economies, is that they're reopening their coal plants, they're extending the nuclear lifespans, and they are relying on traditional baseload energy sources as a buffer. And also, most importantly, there is a move to decentralization. What I mean by decentralization is that rather than depending on global markets and vulnerable maritime routes, countries are building sub regional energy grids. There are bilateral energy corridors, even in a very complex region like South Asia. We have, these energy grids that are in place. There are direct supply agreements. So basically, these projects like India, Middle East, Europe corridor, they're not just economic projects, but they're strategic attempts to bypass insecurity. So that is one thing that is transitioning or changing in the energy policy arena. So the second thing is this, as Dr. Pooja has been pointing out, she was talking about multilateral agreements. So I want to focus on minilaterals. I feel there has been a rise on the minilaterals, that is she was very well pointing about how things are happening at the United Nations and how the international institutions are feeling more crippled while great powers are handling it on the basis of their own rules. So, as now it's kind of established that the universal institutions have been struggling to effectively respond to these crises. So I think that has given more space for minilateral agencies to come up. That is more small. That is the smaller purpose-driven coalitions. So how are they acting? That is, there are security linkages. That is where energy flows are tied to naval protection and strategic partners. That is one thing. Secondly, there is something called friend shoring that is happening. That is, there some of the countries they're relocating supply chains to potentially aligned partners. Then there is, transactional neutrality where states avoid rigid alliances and, they're maximizing flexibility from very small states to middle powers. They are now, they're largely preferring flexibility over any kind of alliances. So that is there. And my last point is on the rise of a buffer economy. What I mean by a buffer economy is that, we cannot treat resilience as an abstract concept anymore. It is becoming kind of a budgetary priority. That is, this strategic stockpiling that is happening everywhere. There is expanding oil reserves. Every country is trying to secure food and critical minerals. So that is one thing, strategic stockpiling. Second thing is about domestic industrial capacity, through subsidies and incentives, what India has already been doing, even much before all these crises happened. Then ensuring, key technologies are produced locally so that, the point is, it's not about efficiency at this point, it is about preparedness. So I think countries are thinking, like they know that things are no longer, stability no longer can be guaranteed. So they have switched on to the survival mode already. And that is basically countries are trying to prepare more for vulnerabilities. And so this when the corridors of trust have eroded, every country is on its own. They're trying to stabilize their domestic situation on their own. They're tackling it in their own possible ways. That's my take on this.
That brings us to the end of our conversation today. I thank you so much, Dr. Pooja Bhatt and Dr. Gayatri Gopal, for such a rich, layered, and truly the thoughtful insights that you have given us today. This conversation has brought up so many important points and also has brought into sharp relief just how interconnected our world is and how these events in one region can have an impact across energy markets, across trade networks, across financial systems and everyday life beyond where the conflict is actually happening and taking place. So I would like to thank the both of you very much for joining today. I'd also like to extend the warmest thanks to all of the people who've watched the discussion today, whether as researchers, students, practitioners, or even just engaged citizens. Your presence and interest in these critical conversations is what makes Global High Tea series meaningful. On behalf of the Center for Public Policy Research, I hope today's discussion leaves you with not just a sharper understanding of the crisis, but also a clearer sense of the policy choices and the strategic decisions that lie ahead. Do keep engaging with us. Follow CPPR for upcoming events, publications, and policy conversations. Thank you to everyone and have a wonderful day.